Fitch and Moody's confirmed Turkey's BB- rating with stable outlook. Latest economic update. Fitch has reaffirmed Turkey's B+ credit rating, signaling a strong economic outlook, while its foreign exchange default rating remains at BB-. This update comes after Fitch highlighted key factors driving its cautious stance, including low government debt, robust banking sector resilience, and high GDP per capita. In its assessment, Fitch emphasized that maintaining a stable inflation path, projected to drop from 35% in June to 21% by 2026, supports its rating. The agency also noted a projected 2.9% GDP growth in 2025, 3.5% in 2026, and 4.2% in 2027. However, Fitch cautioned against a return to negative real rates and stressed the importance of sustained inflation decline. A renewed focus on macroeconomic stability could lead to an upgrade, though this depends on policy credibility and external buffer strength. Meanwhile, Moody's upgraded Turkey's credit rating from B1 to B3, reversing its previous positive outlook to stable. The change underscores improved policy effectiveness, particularly in reducing inflationary pressures and restoring investor confidence. Moody's also raised the country's local currency ceiling to BA3 and foreign currency ceiling to BA2, emphasizing policy improvements while warning of vulnerabilities tied to exchange buffers and potential shifts. Turkey's economic revival, credit ratings, reforms, and investment opportunities. Imagine a country that was once on the brink of economic collapse, but has since made a stunning turnaround to become a beacon of hope for investors. Welcome to Türkiye, a nation that has undergone a remarkable transformation in just 2 years, marked by credit rating upgrades from all 3 major agencies and a significant shift in global investor sentiment. But here's where it gets interesting. This resurgence is not just a result of a temporary recovery, but a deliberate and sustained effort to implement structural reforms and establish policy credibility. For investors, the question now is whether this progress is sustainable and whether Türkiye can evolve into a high-conviction emerging market opportunity. One of the most significant indicators of Türkiye's newfound credibility is the credit rating upgrades it has received from Fitch, Moody's, and S&P Global. By 2024, Türkiye had achieved the rare feat of being upgraded by all 3 agencies, with Moody's upgrading its rating from B1 to BA3, citing a 40+ percentage point increase in policy rates by the Central Bank of the Republic of Türkiye, CBRT. This, in turn, drove inflation down from a staggering 80% in 2023 to 35% by mid-2025. S&P and Fitch followed suit, noting a narrowing current account deficit and improved fiscal discipline. These upgrades are a testament to the growing confidence in Türkiye's ability to manage external shocks and maintain macroeconomic stability. However, it's essential to note that these upgrades come with caveats. Both Fitch and Moody's emphasize that Türkiye's governance ranking remains a concern, with political centralization and legal unpredictability lingering as risks. Yet, the sheer consistency of reforms, despite political turbulence, suggests a maturing institutional framework. And this is the part most people miss. The government's medium-term program, MTP, launched in September 2023, has been instrumental in driving this transformation. The MTP's key pillars include monetary policy discipline, fiscal consolidation, investment climate improvements, and a renewable energy push. These reforms have not only stabilized the economy, but also diversified its growth drivers. For example, Türkiye's distant countries strategy has expanded exports to the US and Asia via digital platforms, helping SMEs navigate complex trade standards. The country's focus on energy self-sufficiency and export competitiveness has also mitigated external pressures. But here's the controversy. Some argue that Türkiye's reliance on external financing and its liquidity ratio, which is below the BB median, remain significant vulnerabilities. Others point to geopolitical tensions, such as regional conflicts and US tariffs on steel and aluminum, as potential risks. So, what does this mean for investors? Türkiye's trajectory presents an asymmetric opportunity, with sectors like automotive parts, textiles, and renewable energy offering attractive entry points. However, success hinges on three critical factors: CBRT independence, structural reforms, and currency hedging. The central bank must resist political pressure to ease monetary policy prematurely, while addressing judicial inefficiencies and tax system regressive features will be crucial for long-term growth. And of course, strategic hedging will be necessary to mitigate the lira's volatility. In conclusion, Turkey's journey from crisis to creditworthiness is far from complete. But its policy consistency and structural reforms have laid a solid foundation. While risks persist, the country's progress in 2023 to 2025 demonstrates a commitment to sustainable growth. For investors with a medium-term horizon, Turkey offers a compelling case, a nation recalibrating its economic model, with upside potential in sectors aligned with global trends like green energy and digital trade. The key is to balance optimism with vigilance, ensuring that gains are protected against potential reversals. So, we ask you, do you think Turkey's resurgence is a sign of things to come, or a temporary reprieve? Share your thoughts in the comments below. Moody's boosts Turkey's sovereign debt rating. What you need to know. In a surprising move that could signal a turning point for Turkey's economy, Moody's, the globally recognized ratings agency, recently upgraded the country's sovereign debt rating. This decision, announced on Friday, reflects a growing confidence in Turkey's financial stability, driven by a disinflationary central bank policy that has stabilized the lira and curbed inflation rates. But here's where it gets controversial. This upgrade comes at a time when many are questioning the sustainability of Turkey's economic policies. Despite the positive news, some experts argue that the country's long-term financial health could still be at risk due to external pressures and internal political factors. Moody's lifted Turkey's long-term foreign currency sovereign credit ratings and local currency issuer ratings to B3 from B1, which might not sound like much to the untrained ear, but in the world of finance, it's a significant step up. The outlook was also raised to stable from positive, indicating a more optimistic future for the country's economic trajectory. This is the part most people miss. The ratings upgrade could have far-reaching implications for Turkey's access to international capital markets, potentially leading to lower borrowing costs and increased foreign investment. But what does this mean for the average citizen? It could mean more job opportunities and a stronger economy. However, it's crucial to remember that while ratings upgrades are a sign of progress, they are not a guarantee of long-term financial stability. And this is where the conversation gets interesting. Do you think Moody's upgrade was justified? Or do you believe Turkey's economic challenges are far from over? Share your thoughts in the comments below. Let's dive deeper into this controversial decision and explore the potential impact on Turkey's economic future.